Next guest covers internet stocks, and he has a new report out with a preview of the fourth quarter. He sees the most upside to estimates like Spotify, Netflix, and Meta, and the most risk Google and MET. Is that right? Joining us now is the author Mark Mahaney, Evercore ISI head of internet research. So, Mark, just to start, are you sort of saying no to most of the big seven and just be sort of pick your way inside of them?
Well, I only cover the large cap internet stocks. I like Meta, Amazon, and Google. But in terms of preferences, Amazon's our number one pick. It's the one stock of the mega caps that really hasn't re-rated or still got more re-rating. The multiple could go higher. Meta would be our number 3 pick. Expedia actually is a bit of a surprise. It's probably our most contrarian call. That's our number 2 pick for the year.
So you're not selling Amazon this morning because it couldn't buy iRobot. That's just a joke, but we were talking about that earlier.
Too small to move the needle for Amazon. Amazon's got a lot of things going for it, but in order for that stock to go up, you need 3 fundamental catalysts. That AWS growth, Amazon Web Services growth, has to accelerate. One. Secondly, they got to hit these record high retail operating margins this year. Pretty high confidence they're going to do that. And third, I think they're going to hit record high free cash flow margins for the company as a whole. And as the free cash flow margins rise, that gives confidence to investors to kind of up the multiple a little bit. The multiple is depressed versus where it was several years ago because of the slowdown in AWS and because of the lack of free cash flow follow through. If you get both of those stock, I know it outperformed last year, but I think it outperforms again this year.
And tell us why you like Spotify.
Global leader in music streaming that finally started proving out the business model. The big knock against Spotify, really since its direct listing or IPO several years ago, was great. They're the global leader in music, but can they generate real profits? It's where you have a very concentrated supplier base. There are three and a half major labels in the world, and so that doesn't leave much economics for the biggest streaming platform, music streaming platform. But that has started to change, in part because the company looks like it's successfully executed on a new price increase at the end of last year. They've also got more marketing dollars coming in from the labels and the artists. And then they're finally, like a lot of other tech companies, really catching cost religion. These RIFs reduction in forces, these job cuts that they've announced, they're painful for all the people involved. I totally get that. But for some of these companies, they were absolutely necessary. I think Spotify was one of them. And what they're showing to the street is that they're a much more cost-disciplined company than they were in the past. They're safer to invest in.
Mark, I like this chart that you have in terms of the spectrum of risk in your coverage universe for this earnings season. And Google is the riskiest. Yeah. Why is that?
It's a cost issue with Google. It's also a little something funky frankly, with the street estimates for the fourth quarter. Look, normally margins come down. Operating margins come down for Google from September quarter to the December quarter for a variety of reasons. They lean more into hardware devices that they sell. They lean more into marketing. A little bit of a mix shift to YouTube. But there's also this thing called the NFL Sunday Ticket, which is dilutive. I mean, almost anything is dilutive to search. But the NFL Sunday Ticket is very dilutive to search. And so I just don't think street numbers kind of catch that. Now, the company could address all this on an earnings call and talk about how they're going to manage expenses better going forwards, but they've never really done that. So I'd love to see Google come out and say, we're really taking a much harder look at costs. But, until they do that, I've just been waiting for too long for them to do that. I'm just going to be a little cautious for them on the cost side. I think revenue is fine. YouTube looks particularly strong now. I think they were actually a major beneficiary of the Hollywood strike last year. But on the cost side, investors want to see cost discipline. I don't think they're going to see enough of what they want out of Google.
Hey, Mark, I don't know if you've had time to put this into your spreadsheet this morning, but Zuckerberg talking about spending $9 billion on AI. How do you process that? Is that an expenditure? Is that a profit thing? How do you process that?
It's operating expense, R&D. I think people have been looking for all these AI plays. They buy the chips and they look for the infrastructure plays, and we're kind of waiting to see where the big AI, Gen AI deployments are. Like where can I find a great killer Gen AI apps? Hey, I got an example for you. Right, it's right in front of us all. It's Meta. They've used AI to much better improve the user experience. They brought so much more content from across the internet, not just from your friend circle, into your newsfeed. And then they used AI to rebuild their ad tech stack after Apple kind of blew it all up with these privacy changes. And now there's the next level of AI deployments, both at Google and at Meta. They're using it to allow companies to create their own creative on the fly.